Getting in and getting out, talking with Bob Miner. Bob, how are you?
I'm great.
Give me some entry and exit strategies that you suggest that are most profitable for traders.
Okay. There's a key concept. I'm really big on understanding concepts. Is the same information that you use to enter a trade, to identify a potential trade opportunity and to enter the trade, you have to use that same information to adjust your stop, exit the trade, in other words, to manage the trade. So, for instance, I use a lot of dual time frame momentum strategies to enter the trade with a relatively small capital exposure. If the market tends to move in the direction I'm hoping it's going to move in, is I use those same type of strategies to adjust my stop. So if I have a momentum that I entered because it was oversold, and then if it ends up being overbought, that means I want to get that stop really close to the market. But until that condition arrives, my stop's going to be far from the market because I want to give it room for that momentum to cycle and to reach an overbought stage.
Particularly in a market that is as volatile as we've seen recently.
Yeah, exactly. Well, an example is last week, we had that big down day, I don't know, Tuesday or Wednesday. It was like a 40-point down day in the S&P, which, and it was a long ways away from the little swing high where the stop needed to be. So I made a trade on a bear market ETF, but my position size was very small because the capital exposure was very long, and it wasn't until just a day or two ago till we took out a new swing low that I even adjusted the stop. So I kept that stop far from the market until we had a reason to adjust it, that the market finally began to trend in the direction anticipated.
So you use not only position size, but the stop to manage the capital exposure.
Absolutely, absolutely. Position size is one of the most important things for any trader, and most people don't pay enough attention to that. So if you identify a trade and maybe there's a large capital exposure because of where your entry would be and where your initial stop would be, you have to reduce that position size, so no matter what type of trade you take, you're never risking more than 2 or 3% of your account size.
Bob, thanks for sharing that with me.
You bet.
Robert Miner's been my guest. You're watching the MoneyShow.com video network.